Continuation on forecasting financial statements, forecasting of financial statements, and the question today will be about Sepetuka. Sepetuka Limited has presented the following statement of profit or loss for the years ended 30th September 2019, 2020, 2021, and also 2022. So these are the presented financial statements for Sepetuka Limited in terms of the statement of profit or loss. Then look at the required. Calculate and interpret the following ratios. Annual revenue growth rates for the years 2020, 2021, and 2022. 3-year cumulative average growth rate, that is CAG, for the year 2022. They also want the effective tax rate for the year 2019 to 2022. Then B, now assume the following for Sepetuka. Revenue growth rates are forecast under 3 scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate for the first year forecast is the 2022 CAG. This is expected to reduce by 2% annually until the last year of forecast, subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods. Number 2, gross profit margin for the first year of forecast is 3-year average for the period from the year 2020 to 2022, and is expected to reduce by 2% annually until the last year of forecast, subject to a minimum of 50%. Operating expense ratios are modeled as a 3-year average for the period from 2020 to 2022. These are assumed to remain constant over the forecast period. Now, depreciation to revenue ratio is assumed to remain constant as a 3-year average for the period 2020 to 2022. Finance costs are expected to reduce steadily as the loans are repaid. We'll be using the reduction rate in the year 2022 over the forecast period. Income tax expense is calculated as the historical effective tax rate. Required, prepare a 5-year forecast statement of profit or loss for Sepetuka Limited for the year 2023 to 2027. Remember, that is part B of the question. Now we start with part A of the question. Part A of the question, which is calculate and interpret the following ratios. Part A of the question, calculate and interpret the following ratios. Then the first one is the cumulative, the annual revenue growth rate for the forecast period. So that is Roman 1 of what they want us to get. Now with the annual revenue growth rates, after creating this schedule, we want to get the revenue growth rate for the year 2020. Now for the year 2020, if you look at our question, then the growth rate will be the revenue for 2020 minus the revenue for 2019 over the revenue for 2019. Remember, the change of revenue over the original revenue. So the change, that is 2020 minus 2019 over 2019. That will be how you get the revenue growth rate. So that will be equal sign, open bracket, scroll up and click on the revenue for 2020, minus the revenue for 2019, close bracket, so you close bracket, then divide with the revenue for 2019. So what have we done? The revenue for 2020 minus the revenue for 2019 over the revenue for 2019. You enter, that will give you the growth rate, which will be dragged across. You simply drag that across and it will give you the other revenue growth rate. That's how you get the revenue growth rates. Now, Roman 2, they want the 3-year cumulative average growth rate. So 3-year cumulative average growth rate. The 3 years cumulative average growth rate. The 3-year cumulative average growth rate. cumulative average growth rate. So 3-year cumulative average growth rate, a CARG. So CARG can be obtained using two ways. So CARG, cumulative average growth rate, you can use the following formula. So we want to say use of formula. And the formula will look as follows. Use of formula. You will take the closing revenue over the opening revenue, so closing revenue over the opening revenue, raised to power, open bracket, 1 over t, close bracket, then minus 1. That is use of formula. Now you can also use power function, use of the power function. So those are the two ways that we want to use so that we get our CARG. So you can use formula or you can use the power function to get CARG. Now to summarize, closing revenue, we get the closing revenue. That is not typing. So closing revenue, and you also have opening revenue. Now they want 3-year average for the year 2022. That therefore means that closing revenue will be for the year 2022. That will be equal sign. When you move up, the year 2022 revenue is 95,580. Then opening revenue, 3-year means it now started in 2020. So that is 64,800. We go for 64,800. So the closing is 95,580. The opening is 64,800. That is the revenues that we have. Now after that, we compute CARG using formula. Will be as follows. So CARG using formula will be as follows. Equal sign. Open bracket. Click on the closing revenue. Divide by. Then you click on the opening revenue. Close bracket. Raised to power. Open bracket. 1 minus, so it's 1 minus. Now T will be 2 years, not 3. They said for 3-year cumulative average, but if you count from 2020 to 2022, so we just have 2021 and 2022. So that will be 2 years that will be used. So 1 minus 2, close bracket, then minus 1. There's a problem in the way I've done the formula, so it should be 1 over here. So 1 over 2. 1 over 2, then minus 1. So the answer is 0.21. Convert that to percent, then perhaps 2 decimal places. So to bring this down to here, we can add that T is equal to 2 here. T is equal to 2. that is CARG by using formula. CARG CARG using power, CARG using power function, using the power function. Now, when using the power function, CARG will be as follows. When using the power function, that will be equal sign power, then tab. We have number. Now number will be the closing revenue divide with the opening revenue. That will be our number, comma. Then power will be 1 over 1 over 2, then close bracket, 1 over 2, then close bracket and enter. Still this not the same answer. The power looks wrong, or we need to less 1 at the end. We need to less 1 at the end. Yeah. So using the power function, equal sign power, the closing revenue over the opening revenue, comma, then 1 over t, which is 1 over 2, close bracket, then minus 1. That gives you the power function. If you enter, convert this to percent, then 2 decimal places. Number Roman 3, effective tax rates. We also have the effective tax rate. Effective tax rate. From the year 2019 all the way to the other period. So the effective tax rates, 2019 to 2022. The tax rate from 2019 to 2022 will be equal sign, then move up. Look at the taxes. So you can do equal sign, then negative. You want it to be a positive figure. Equal sign, then click on the tax, the income tax. Divide that with 5,200. Remember, it is equal sign negative because we want a positive tax rate. Then click on the tax, then divide by profit before tax. So the tax divided by profit before tax. It's 30%, then drag across. You drag across, all the others I believe are just 30%. That is the tax rate. We now move to number B. Number B is here, prepare forecast statement of profit or loss. We now want to prepare a forecast statement of profit or loss. A forecast statement of profit or loss from 2023 to 2027. Is analyzing variables. So we want to start by analyzing variables. Now on analyzing key items, look at number B. Now assume the following. Revenue growth rates are forecast under 3 scenarios, namely best case, optimistic case, and pessimistic case. The best case growth rate for the first year of forecast is 2022 CARG. This is expected to reduce by 2% annually until the last year of forecast, subject to a minimum of 15%. Okay, so we can check that first. We analyze that here. The scenario. So start by giving me CARG or scenario analysis. We start with scenario analysis. Then we have CARG. CARG has been given us 21.45. So we have 21.45 up there. That is CARG, 21.45. Then we have the base case. We have the base case. After base case, we have base case and what? Optimistic. Okay, let us go. So we have base case, then optimistic case, then we also have pessimistic case. So the question said, if you go through that note, they said here that the base case for 2022 is the CARG. The base case for the first year of forecast is the CARG. That is the CARG. So the base case for the first year of forecast is the CARG. So base case is equal sign CARG. Take the CARG. The same area told us that the optimistic case is 20% above the base case, while pessimistic is 10% below the base case. So let's see. Optimistic will be equal sign. Click on the CARG up there, the one written CARG, times, open bracket, 1 plus 20%, because it will be 20% above the base case. Optimistic will be 20% above the base case. That gives you 25.74. Pessimistic, you take the CARG times, then you open bracket, 1 minus 10%, because they said it will be 10% below the base case. So this one is 19.30. So we have those three scenarios already before we proceed. Choose scenario. We want to talk about choosing scenario. So choose scenario. Choose scenario. Choose scenario. Right here, 1. So choose scenario, then you write there 1. Because we have 3 scenarios. Then we can go and use data validation. Use data validation to have 1, 2, 3, because we have 3 scenarios. So go to data, then validation, data validation. Under any value, go for list, then source is 1, 2, 3, because we have 3 scenarios that we'll be picking from. When you click on this arrow, now we have 1, we have 2, and we have 3 scenarios. So 1. Now on the cell that follows on the right here, we want to use the if statement, something to do with the if statement. So that will be equal sign if, then tab. If this cell, this one here, what you have here, if this cell is equal to 1, if that cell is 1, comma, then the formula should give you in double quotation, base case. Base case, close the double quotation, then comma. Again, if the same cell now is equal to 2, comma, double quotation, the formula should give you optimistic. Optimistic case, that will be optimistic case. Close the quotation, comma, if, again tab, the same cell, the D74 in my case is equal to 3, then the formula should give you the last part, which is pessimistic case. That is pessimistic case. Close the quotation. and close with three brackets. Close with three brackets and enter. So that if this is 1, you can see it's already base. But if this is 2, it will be pessimistic. But if this is 3, then it will be pessimistic. If you return this to 1, then it goes to the base case. Take the scenario back to 1. So just click on the arrow and select 1. Take the scenario back to 1. Then lastly, this side, this other side, we now want to use the choose function. This is what we refer to as the choose function. We'll just do equal sign, then choose. Choose. Remember all these things, we have done them somewhere in Excel. So choose. The index number. Our index number is where there is 1. Then comma. Then the values. The values, click on the base, the 21.45. This 21.45, comma. 25.74, comma, and 19.30. That is all. Close bracket, enter. Now the rate will be given here. Just convert it to percent. Convert that to percent. So by the time you are changing anything here, if you choose a scenario to, let's say, 2, changes to, you can see it's changing the other side. If you are picking another one, let's say 3, it's also changing on the other side. If you are picking 1, that will also be changing to what we have there. Variable interpretation. Variable interpretation is something there that affects so many things that we want to interpret. Now, note 1 again, note 1, not note 1, but number B, where we had number B, there's an information here. So the revenue growth rates under 3 scenarios, the base case and all that, then this is expected to reduce by 2% annually until the last year of forecast, subject to a minimum of 15%. So that will be subject to a minimum of 15%. So we want to do that for revenue growth rate. So we create something under interpretation of variables. We create some. Now, once we have created a schedule like this for the previous years, then the detail, then the years under forecast. Remember, we are forecasting for 5 years. We move to the first note, which said, the first note again, B note 1. The base growth rate for the first year is CAR. Okay, this is expected to reduce by, so that is revenue growth rate, I believe. Revenue growth rate will be the first one. So the first one, in the first year of forecast is the 2022 CARG. So the first one is the 2022 CARG. So this will be revenue growth rate. First detail is revenue growth rate. The revenue growth rate. Revenue growth rate. Now the first one for 2023, the first one for 2023 will be equal sign. Equal sign. It will be the CARG for 2022. So we have CARG for 2022. That will be 21.45. 21.45. Now they said, if you go through the question, the statement, this will reduce. This is expected to reduce annually until the last year of forecast, subject to a minimum of 15%. So it will reduce by 2% annually until the last year of forecast, subject to a minimum of 15%. Reduce that by 2%, but it should not go beyond 15%. So 2024 will be equal sign mean, equal sign mean. Is it mean or max? Mean or max, because there is a minimum, subject to a minimum of, I think we should be using max. Max, not mean, but max, unless I'm wrong. Max, then tab, click on 21.45, 21.45 minus 2%, 21.45 minus 2%, but, comma, it should be a minimum of 15%. It should not go below 15%. That should not go below 15%. Close bracket and enter. So the first one is this. Can convert that to a percent, 2 decimals, then drag across. You can see the last one is 15%. So the mean function, if you use the mean or the max function, prevents this from going below what they said, 15%. If it goes below 15%, then it's going to pick the maximum, which in that case will be 15. So that is for revenue growth rate. Now that will apply even if you pick another scenario. Let's say you pick another scenario, even the pessimistic one, the minimum will just be 15%. It will not go below the 15%. Even if you pick this other one, it will not go below the 15%. Now the next analysis, number 2, gross profit margin for the first year of forecast is 3-year average for the period from 2020 to 2022. This will reduce by 2% until the last year of forecast, subject to a minimum of 50%. So gross profit margin is the average of the period 2020 to 2022. So this is gross profit margin. Gross profit margin, that is the gross profit margin. Now give me the gross profit margin for 2020, 2021, and 2022 so that we can get the average. So the one for 2020 will be equal sign, the one for 2020, gross profit margin. Remember, gross profit margin is gross profit for the one for 2020. Divide that with sales. That is the gross profit margin. The one for 2020 over sales. So gross profit over sales. Just drag across. Convert to percent. Halves to decimal. Now get the average. They said it should be the average. The first one will be the average. So equal sign average. In the first year of forecast will be the average of these 3. Close bracket, enter. Convert this to percent, 2 decimal places. Now the first year of forecast will be the average for the previous years from 2020 to 2022. Then this will reduce by 2%, they said, subject to a minimum of 50%. So it will reduce annually by 2%, subject to a minimum of 50%. So the other forecast years from 2024 moving forward, it will be equal sign, then again max, tab. This minus 2%, subject to a minimum of 50%. So subject to a minimum of 50%, close bracket and enter. Of course, convert this to percent. Then drag across. What follows after number 2? After number 2, we move to number 3. Operating expense ratios are modeled at 3-year average for the period 2020 to 2022. These are assumed to remain constant over the forecast period. Again, that is not just like what we did in revenue. You get the operating expense ratio. So operating expense ratio are modeled as a 3-year average from 2020 to 2022, and they will remain constant over the forecast period. So this will be the operating expense ratio. Operating expense ratio. Operating expense ratio. I'll get the previous operating expense ratio. So for 2020, it will be, click on 10,125, divide that with 64,800. Don't negate anything. And you're getting 0. This, convert that to percent, to decimal, drag across. So they said it will be the average, so equal sign average, get that average, close bracket and enter, convert that to percent. If it's bringing something else, then that will remain constant throughout the forecast period. So constant means equal sign, click on this, lock that, enter, and it will remain constant throughout the forecast period. Constant throughout the forecast period. After that, number 3, if not 4, depreciation to revenue ratio is assumed to remain constant as a 3-year average from 2020 to 2022. That is depreciation to revenue ratio. Depreciation to revenue ratio. Depreciation to revenue ratio. Get for 2020. So depreciation to revenue ratio will be, click on depreciation for 2020, divide that with sales for 2020, then convert that to percent, to decimal, drag across. Now they said that depreciation to revenue ratio will be is to remain constant as a 3-year average. So you get the average, and then it will remain constant. For 2023, equal sign, average, tab, get this average, close bracket, enter, convert that to percent, to decimal, then it remains constant over the forecast period. Remains constant over the forecast period. Percent to decimal, drag across that way. Then 5, finance costs are expected to reduce steadily as the loans are repaid. We'll be using the reduction rate in the year 2022 over the forecast period. So finance costs are expected to reduce steadily and use the reduction rate in the year 2022. So here we have finance cost. Finance cost. So we get the reduction rate in the year 2022, only 2022. That will be equal sign. I believe there is bracket, equal sign, then bracket. Go to 2022 under finance cost. This is finance cost. So equal sign, bracket, then click on 8,000. We want that reduction rate, minus, click on 9,000, 8,000 minus 9,000, close bracket, then divide that with the 9,000 again. We want a reduction rate. So 8,000 minus 9,000 over 9,000, then enter. So the reduction rate of the year 2022 will be used over the forecast period. So equal sign, lock this because it becomes constant. Enter, convert to percent, to decimal, drag across. Okay. Lastly, after finance cost, we have income tax expense. Income tax expense is calculated as the historical effective tax rate. So historical effective tax rate. So we have the income tax. That is not difficult. Just pick the income tax rate, the income tax rate. Just do equal sign. It is up there. That is something that we did. You can see the historical effective tax rate. The historical effective tax rate. You can click on any, even the 2022 and lock, because the historical one is 30, 30, 30. Then convert that to a percent, to decimal, then drag across. We are going to get that as our final answer. in this. So it's 30 throughout, and we are done with that interpretation of some key variables. Interpretation of key variables in our question. So you can see from revenue growth rate to CARG, cumulative average growth rate, to effective tax rate, to the starting of the analysis of some key variables. We've analyzed a lot of the scenario analysis. Now this was the main part. If you get this correct, then you've done the question. Then lastly, we want now to prepare that forecast statement of profit or loss. This one. Now on to the forecast statement of profit or loss, having already prepared the schedule for the forecast statement of profit or loss. So we have the base year, the year that we'll be basing this on, the 2022 results, then we have 2023, 2024, 2025, 6, and also 7. Here we have the details. Details. So that will be equal sign. We have all those details up there. So equal sign, then click on our details, cells, the cells, enter, then drag down. So from cells, then you drag down. From cells, then drag down. After that, the results for the year 2022, results for the year 2022 will be equal sign, then pick what we have as the year 2022, 95, enter, then drag down. So these are the results for the year 2022. Results for 2022. Now, once you have the results for 2022, see details, then results for 2022, we can now forecast from 2023 moving forward. We will be following what we have in our analysis. You can see how revenue behaved. The revenue growth rate, we can see the revenue growth rate is here, and we have the original amount. So that will be equal sign for the year for sales and how it was growing. Click on 95. Click on 95 times, then open bracket, 1 plus, then click on the first rate under the revenue growth rates, hapo juu, then don't lock anything, of course, close bracket, then you close bracket, enter. That becomes our revenue for the next period, the revenue for the next period. That will be dragged across to the end. Revenue. Cost of sales is not given. There is no way of getting cost of sales, but you know we can get gross profit margin. We can get gross profit margin. So gross profit margin is given up here. So you simply multiply this with revenue. If you multiply this with revenue, then you are going to get the gross profit margin. So go to gross profit and say equal sign. Click on your revenue for 2023 times, then click on the gross profit margin that you've gotten up there, Don't lock anything and enter. That will give you some gross profit. You can change that format. You customize the format to pick what you want, or you can reduce that to 2 decimal places. That is gross profit. When you have gross profit, you can get cost of sales. When you have gross profit and sales, then you can get cost of sales. So that will be equal sign. Click on gross profit minus sales. So gross profit minus sales will give you cost of sales. Then drag that across. I want it to be negative. That's why I took gross profit minus sales. We have the ratios. Remember, they relate with sales. So that will be equal sign sales that you have times the operating expense ratio times the operating expense ratio. Enter. You can drag across, convert that to a format that we want. Control 1, custom, then you pick this. So Control 1, custom, then click on this. Can be aligned at the center. Then go to operating profit. Now operating profit will be the summation of these two. Summation of this, alt equal. That gives us the operating profit. This is operating profit. So the depreciation to revenue or depreciation expense will be equal sign. Click on the sales times sales times this ratio, depreciation to revenue ratio. Enter. Then format accordingly. Control 1, custom, then this part. Can center it. Now get profit before interest and tax. Select this. Alt equal. And that is profit before interest and tax. Profit before interest and tax. Finance cost will reduce by 11%. So finance cost will reduce by 11%. That will reduce by 11%. So that will be equal sign. Equal sign. The one that you have here times open bracket 1 plus 1 plus, then just click on the finance cost here, the 11.11. Close bracket. You are adding because this is already negative, so don't less again. It will just reduce. Drag across, format. Okay, then that can be centered. So you can see it's reducing steadily as they said. Profit before tax, alt equal to get our profit before tax. Profit before tax. Profit before tax. Income tax expense. The income tax expense, that is just equal sign profit before tax times, then click on the 30% up there. Enter. Times the 30%, then you enter. Now it's positive, so change the formula to negative something. So times negative 30. So times negative 30 times negative 30, then now gives you a negative answer. Drag across again. Income tax expense is obtained there, then profit for the year. Can sum this for our profit for the year. Alt equal and we arrive at the profit for the period. So that becomes the profit for the year, and also the last part that we do on this. That is what they wanted. If you know how to edit and format, then this can be put all in borders so that ends there. But they wanted for the three scenarios. The question was for the three scenarios. Now we have the base. What we've just done is base. They also want optimistic. There was also pessimistic. So there were three scenarios, but you don't have to do all of them. That is why we had this as a part for choosing scenario. So we choose scenario by using this. Now I want you to click somewhere here. There's a space. I believe there's also a space here. Equal sign. Then click on the base case. There's this term base. Under choose scenario, there's base. Then you will have that here. It will be changing as you change anything. That will just be changing. Then you can go ahead and include it in our that way. So base case. That is the base case. Now, if you are asked about the other scenarios, this is too big, about the other scenarios, then that is why we had the choose scenario. You simply move up and pick another scenario. Let's say you are picking scenario number 2. Now it becomes optimistic. In fact, it changes to optimistic. Now look at optimistic. The results have changed. Optimistic results have changed. And if I change to pessimistic, so choose again to pessimistic, now this one changes again to pessimistic, and the results are now different, and they are showing pessimistic case. Now there is the best case, there is the optimistic case, and there is also the pessimistic case. You can keep changing by using this part for choose scenario. Choose scenario. If you want, you can use even different colors here. If this is pessimistic, blue. If it is the other one, red, that way. But we don't want to go into those other things. So pessimistic, you can say, you can even just type here 1, becomes base, and the answers are changing. Let me zoom so that you can see how those answers are changing. If you change this to 2, most of these answers are changing. If you change this to 3, these answers are changing. If you pick again 1, the results are changing. So we have done that under all those 3 scenarios. So you leave it at 1, and you may decide to remind the examiner to be changing scenarios. So switch between scenarios. So switch between scenarios here. Any questions?